Usually when we try to check the health of the economy, we're mostly looking at lagging indicators,
Right.
like a chart from the government or some inflation index or even just, the price of a gallon of milk at the store.
Yeah.
We're essentially just looking in the rearview mirror. But I mean, imagine if you could just open up the hood of the entire global economy in real time.
That would change everything.
It really would. What if you could, look inside the bank accounts of half the American public and peek at the deal flow of the world's biggest corporations
Right.
and see exactly what the smartest people in finance are actually doing with their cash today?
I mean, you wouldn't just be guessing at economic trends anymore, Rar. You would have this highly localized map of where the money is actually flowing.
Exactly.
Right down to the dollar, way before any of those trends ever hit the evening news.
So today is exactly April 14th, 2026, and JPMorgan Chase just dropped their Q1 2026 financial results.
Fresh off the press.
Yeah, literally today. So we're doing a deep dive into this. We're using their quarterly earnings release and the accompanying presentation as this massive decoder ring to try and understand the health of the entire U.S. and global economy.
This is the perfect tool for it.
Right. We're looking at what this actual data means for you, whether you're, trying to figure out if we're heading for an economic boom, a devastating bust, or maybe just some weird twilight zone in between.
What's fascinating here is the sheer, frankly, incomprehensible scale we are dealing with.
Oh, yeah.
Because it is very easy to just dismiss quarterly earnings reports as, these boring spreadsheet reviews meant only for Wall Street analysts.
Right, just a bunch of numbers.
But you have to remember, JPMorgan Chase sits on $4.9 trillion in assets.
Trillion.
Trillion, with a T.
That's just insane.
It is. I mean, if this bank were a country, it would be one of the largest economies on Earth.
Wow.
So they are the ultimate financial thermometer. By analyzing their balance sheet, we can actually see if average consumers are, putting their groceries on credit.
Right.
Or whether massive global corporations are actually expanding their supply chains. And crucially, what the financial world really believes is coming next.
Okay, let's unpack this because $4.9 trillion is incredibly hard to wrap your head around.
Oh, totally.
So let's start at the very top, kind of from the macro perspective. The CEO, Jamie Dimon, he usually uses these quarterly letters to set the stage for the whole world economy, right?
It does, yeah. It's almost like a State of the Union for finance.
Right. And this quarter, the numbers he's presenting are just staggering. So for Q1 2026, their net income hit $16.5 billion.
Incredible.
And that is up 13% year over year. Plus, their managed revenue is $50.5 billion, which is up 10%.
Massive growth.
Yeah. On the surface, I mean, those are simply not the numbers of an economy that is slamming on the brakes.
No, not at all. Dimon's diagnosis of the U.S. economy right now is notably resilient. He explicitly points out that consumers are still earning and spending.
Yeah.
And businesses remain fundamentally healthy. But, the report doesn't just throw out big numbers. It actually breaks down the specific mechanisms driving all this growth.
Right. The details.
Yeah, they outline a very specific set of what they call tailwinds pushing the economy forward.
Yeah, the report lists factors like increased fiscal stimulus, the benefits of deregulation, and this massive wave of AI-driven capital investment. Oh, and the Federal Reserve's ongoing asset purchases.
All huge factors.
But I actually want to pause on that AI point.
Sure.
Because it's literally everywhere right now. But how does AI actually translate into a bank making $16.5 billion in profit?
Well, that is the crucial distinction between a tech trend and a true macroeconomic driver.
Okay.
Because when we hear AI, we tend to think of chatbots.
Right.
Or just software.
Right, like an app on your phone.
Exactly. But the reality of artificial intelligence is highly physical and incredibly expensive.
How so?
To build AI, corporations need massive data centers. They need thousands of specialized microchips, huge amounts of copper wiring, specialized cooling systems.
Oh, wow.
And they need vast, vast amounts of electricity. All of that requires serious capital.
So they need loans.
Precisely, yeah. When a tech giant or an energy company needs $5 billion to build a new AI infrastructure hub, they go to a bank like JPMorgan to finance it.
That makes total sense.
Yeah, so that tailwind is quite literally the bank funding the physical build-out of the next technological era.
Okay, so what does this all mean then? Because Dimon immediately follows up this super rosy picture of AI investments and consumer spending with a pretty intense list of headwinds and risks.
He really does. He pivots fast.
Right. He mentions geopolitical tensions, ongoing wars, high volatility in energy prices, trade uncertainty, large global fiscal deficits, and elevated asset prices.
It's a heavy list.
It is. I mean, are they preparing for a hurricane while having a picnic in the sunshine? Like, how does a bank actually operate when the CEO is looking at a booming economy on one hand and terrifying global instability on the other?
Well, you operate by building a fortress.
A fortress.
Yeah, that duality is exactly why Dimon constantly references maintaining a fortress balance sheet.
Right, I saw that phrase in there.
Because you don't start preparing for a hurricane when it makes landfall, you know. You reinforce the walls when the sun is still shining.
Ah, okay.
In practice, this means they are playing aggressive offense while simultaneously maintaining a highly protective defense. Just in this first quarter of 2026 alone, JPMorgan distributed about $855 billion of credit and capital.
Wait, $855 billion in one quarter?
Yes. They're absolutely fueling the economy. I mean, they extended $72 billion to consumers, $8 billion to small businesses, and a massive $750 billion to corporations.
That is wild.
They are actively lending, but they are structuring those loans and holding enough cash in reserve so that if, say, one of those geopolitical flashpoints suddenly blows up the global supply chain.
That doesn't just crumble.
Exactly. They survive the storm.
Okay, so let's look closer at where that $855 billion is actually landing. Because following the money tells us what is really happening on the ground.
Yeah.
The report basically splits this into the Main Street side and the Wall Street side. Let's start with Main Street, which they call Consumer and Community Banking, or CCB.
Yeah, the everyday consumer.
Right. So the revenue here rose 7% to $19.6 billion. And in just 3 months, they opened over 450,000 net new checking accounts.
That's a huge influx.
Yeah. And active mobile customers are up 7% to 63 million people. Debit and credit card sales volume is up 9% too.
So the consumer is clearly swiping their cards. And, buried in that consumer division data is this highly specific, frankly fascinating quirk that tells a much deeper story about the American middle class.
Oh, what is it?
The bank reported a $145 million net reserve release in this division.
A reserve release. What exactly does that mean?
It's essentially a mechanical accounting adjustment. Banks are required by law to set aside a massive jar of cash to cover loans they expect might go bad.
Okay, like an emergency fund.
Exactly. But if the economic weather improves, they can look at that emergency jar, decide they don't need quite so much cash sitting idle, and just release it back onto their income statement as pure profit.
So they freed up $145 million.
Yeah. And the primary driver for that $145 million release was actually improvements in home prices.
Oh, I get it. Homeowners have more equity now, so they're way less likely to walk away from their mortgages, which makes the bank's loan portfolio inherently safer.
Precisely the mechanism at play. Because think about it, if you bought a house for $300,000 and the market says it's now worth $450,000, you will do almost anything to avoid defaulting on that mortgage.
Because you'd lose all that built-in wealth.
Exactly. The bank's risk models recognize that psychological and financial reality, which allows them to safely release those reserves.
Okay, but here's where it gets really interesting. Because I want to push back on this whole narrative of the bulletproof American consumer for a second.
Sure, go ahead.
When you look deeper into the presentation slides, there is a very specific metric that paints a much darker picture, I think.
You're talking about the credit cards.
Yes. The card service's net charge-off rate. This is, the percentage of credit card debt the bank essentially just throws its hands up at and writes off as totally uncollectible.
Right.
That rate is sitting at 3.47%, which is up from last year. And firm-wide, their total credit costs were $2.5 billion, which includes $2.3 billion in actual net charge-off.
It's a big number.
It is. So if consumers are so incredibly resilient and, home prices are providing this great cushion, why on earth are credit card charge-offs climbing so significantly?
Well, it's the counterintuitive part of consumer finance, really.
Hmm.
Rising defaults can actually coexist perfectly with rising profits.
Wait, really? How?
Because high credit card revolving balances, meaning people who can't pay off their cards at the end of the month and have to carry that debt forward, those are incredibly lucrative for the bank.
Oh, because of the interest rates.
Yes. They charge steep interest on those revolving balances, and that is a massive driver for that $19.6 billion in consumer revenue we just talked about.
Wow.
But it's an actuarial reality. When a population carries more high-interest debt, a certain percentage of them will inevitably fall off the tightrope and default.
So they are basically making so much money off the, let's say, 96.5% of people paying 22% interest
Right.
that they can just easily absorb the 3.47% of people who completely default.
It is a totally calculated numbers game.
Yeah.
Consumers are spending heavily right now to keep up with inflation or maybe just lifestyle expectations, and they're relying a lot more on revolving debt to do it. The bank knows full well this brings higher default rates. But circling back to that $145 million reserve release, the strength of the housing market provides a real macroeconomic floor.
Okay.
As long as the broader lending portfolio, particularly mortgages, remains rock solid, the bank can easily absorb the localized pain of rising credit card defaults.
Okay, so if the American consumer is playing this high wire act with revolving debt just to keep the economic engine humming, what is happening on the corporate side of the equation?
Oh, it's a completely different vibe.
Yeah, let's look across the building at Wall Street, their commercial and investment bank division. Because if Main Street had a solid, if slightly stressed quarter, Wall Street had an absolute blockbuster.
They really did.
Revenue was up 19% to $23.4 billion. Markets revenue, which, encompasses their massive trading floors, hit an all-time record of $11.6 billion.
Record-breaking.
Yeah. Fixed income trading is up 21%, and equity trading is up 17%.
The trading numbers are definitely staggering. But I'd argue the investment banking fees are perhaps the most revealing metric about corporate confidence right now.
How much were those up?
Those fees surged 28%, and that was driven by heavy advisory and equity underwriting activity.
Right, and they actually secured the #1 ranking globally with a 9.8% wallet share.
Huge market dominance.
And their asset and wealth management division saw $54 billion in long-term net inflows, pushing their total assets under management to an unbelievable $4.8 trillion alone.
So to understand the why behind those specific numbers, you really have to look at corporate psychology.
Okay.
A 28% surge in investment banking means that CEOs and corporate boards are waking up and deciding, the water is finally warm enough to swim.
They're ready to make moves.
Exactly. They are paying JPMorgan to help them acquire competitors, merge with rivals, or issue new stock to the public.
Yeah.
And it ties directly back to that AI tailwind we discussed earlier.
Ah, right. The infrastructure build-out.
Yes. Companies are completely restructuring their businesses for the next decade, and they need investment bankers to structure those massive deals.
That makes sense.
Meanwhile, the massive trading floor revenues, the fixed income and equities, that shows that market volatility is high. Traders don't just make money when markets go up,
Right.
They make money when assets move rapidly in any direction just by capturing the spread.
Okay, so with the consumer spending on credit, corporations merging, and the wealthy pouring $54 billion in new cash into the market, the bank is generating record-breaking profits.
Unprecedented profits, really.
So what is stopping them from taking all this momentum and just loaning out even more money to businesses that desperately want to grow?
That brings us to the most contentious, heavily debated section of this entire quarterly report.
The regulations.
Yes, the regulatory environment. Dimon devotes significant real estate in his commentary to his absolute frustration with federal regulators. But to truly understand his argument, you have to look at the massive safety net the bank is currently mandated by law to hold.
Yeah, the raw numbers on slide 4 detail this safety net. They currently hold $291 billion in CET1 capital.
Right.
Which, for anyone who doesn't spend their life reading bank regulations, CET1 stands for Common Equity Tier 1. It is basically the financial fire insurance deductible that the bank pays itself.
That's a great way to put it.
Thanks. Like, if a massive loan goes bad, this is the shareholder money that evaporates first, protecting the actual depositor's money.
Exactly.
But on top of that $291 billion, they have $572 billion in total loss-absorbing capacity and a staggering $1.5 trillion in cash and marketable securities, just sitting there.
Just sitting in reserve. Now, Dimon does acknowledge that recent capital proposals from regulators mitigated the quote, most severe consequences of the rules drafted back in 2023.
Right.
But there is this ongoing, incredibly high-stakes battle over the U.S. Basel III Endgame, often abbreviated as B3E in the GSIB rules.
And GSIB stands for Global Systemically Important Banks, right?
Right.
So is this basically like, okay, it's like the government is forcing a city's power grid to keep 50% of its electricity stored in massive backup batteries just in case of a once-in-a-century megastorm?
I like this analogy.
But the grid engineers are arguing, hey, locking up all this power is causing brownouts in the local factories right now.
Yes. If we connect this to the bigger picture, the federal regulators are the ones who are still haunted by the ghost of the 2008 financial
They
crisis.
don't want to repeat.
Exactly. Their mandate isn't to maximize JPMorgan's profits. Their mandate is to prevent a catastrophic banking collapse that takes down the entire global economy.
Because JP Morgan is a global systemically important bank.
Right. If a local credit union makes a bad bet and goes under, a single town has a bad week. But if JP Morgan collapses, the global ATM network freezes, payrolls bounce across the country, and international trade basically halts.
Wow.
That systemic risk is exactly why regulators demand that $1.5 trillion mattress of cash and securities.
Yeah, and the presentation lays out the bank's internal math on these new rules. JP Morgan estimates a roughly 4% total impact to the required CET1 capital.
Which is substantial.
It is. That's driven by a 6% hit from the Basel III Endgame rules, but offset slightly by a 2% benefit from changes to the GSIB rules. But, Dimon doesn't mince words here.
He never does.
He explicitly argues that the U.S. GSIB surcharge is, quote, still broken. He claims there are overlaps in the rules that basically double count risks, and he insists that capital needs to be freed up to support the real economy.
Yeah, Dimon frequently refers to this regulatory approach as gold-plating the rules.
Gold pleating.
Yeah, he is essentially arguing that the bank is already bulletproof. So by forcing them to hold increasingly absurd amounts of excess capital in the vault just to satisfy these overlapping regulations, the government is artificially restricting JP Morgan from funding the real economy.
So it actually hurts growth.
Exactly. Every single dollar locked in a vault to satisfy a redundant GSIB surcharge is a dollar that cannot be loaned out to, say, a hospital building a new wing.
Or a city upgrading its water system.
Right, or a factory trying to add a second shift. This raises a really important question about the fundamental trade-off in modern finance. How much systemic safety are we actually willing to pay for by sacrificing economic growth?
It really is a profound tension because you obviously want your banking system to be unimaginably safe, but you also desperately need capital to flow freely so the economy can actually expand.
It's a delicate balance.
And reading through this Q1 2026 earnings report, it feels like JP Morgan is using their $16.5 billion profit not just as a victory lap, but almost as a broadcast message to Washington, D.C.
Oh, without a doubt.
They are effectively saying, look at these numbers. We know how to manage risk in a highly volatile world. Just let us do our jobs.
Yeah, the entire subtext of the report is just competence in the face of immense complexity. They are proving they can manage rising credit card charge-offs on Main Street, capture absolute record trading revenues on Wall Street, and navigate unprecedented geopolitical headwinds, all while generating massive returns.
Which brings us back to you, the listener. We've traced the money from global macro trends all the way down to the reality of the consumer relying on credit card debt.
Yep.
We've seen Wall Street deal-making surge on the back of the AI boom, and we've unpacked the regulatory friction over capital reserves that is clearly keeping Jamie Dimon up at night.
It's a lot to process.
It is. The ultimate takeaway from these Q1 2026 results is that JPMorgan Chase had an absolute blowout quarter. But underneath the hood of the largest bank in the world, the mechanics show an institution that is aggressively bracing for global headwinds.
Right, and fighting an intense battle over how much cash they have to keep locked away for a rainy day.
Exactly. They are managing for a very wide range of outcomes here. They're definitely not assuming the sunshine will last forever, even if the current consumer data looks remarkably strong. The fortress is fully funded.
And that leads me to a final thought for you to chew on, something that really stuck with me from these documents, and I think it highlights a fascinating psychological paradox in our current economy.
What's that?
Well, we talked earlier about CEO Jamie Dimon explicitly listing elevated asset prices as a major economic headwind.
Yes.
He is basically warning the market that stocks, real estate, and other assets are priced way too high and carry significant risk.
Right.
Yet, in the exact same quarterly report, we see that his own asset and wealth management division just took in $54 billion in long-term net inflows from wealthy clients.
Right into those same assets.
Exactly. That is $54 billion being put right back into those very same elevated assets he's warning about. The disconnect between the institutional warning and the actual behavior of the wealthy investor is just striking. It really suggests a massive fear of missing out, or maybe just a belief that there's simply nowhere else to put capital in this environment.
Exactly. So my question to you is this. If the smartest people steering a $4.9 trillion ship are simultaneously warning about dangerous asset bubbles while their wealthiest clients refuse to stop buying into them, are you looking closely enough at the hidden risks in your own financial life?